Yeah, so very happy to have you, Dr. Julius. Thank you for just taking some time to out of your Saturday to share your wisdom and expertise in this area. I'm going to give a quick bio of you, and then I'll let you fill in any gaps. I don't want to steal your thunder because you have a very, very impressive background and resume. So you are the CEO and co-founder of XSITE Capital Investments, started in single-family real estate and angel investing. You've invested in over 50 startups, as well as you're on the advisory board of 4 healthcare related startups. You're a Forbes Business Council member, medical degree with honors from Howard University, residency and fellowship at NYU Hospital for Joint Diseases, and you work as an orthopedic surgeon in Baltimore. So incredibly impressive. And I will let you take it from here and talk to all of our guests and attendees about the ABCs of passive investing and multifamily real estate.
Thank you so much for that wonderful introduction, Drew. Really appreciate you. And I'm super excited to be here. I am Dr. Julius, CEO and co-founder at XSITE Capital, where we collaborate with our community of investors to acquire multifamily real estate assets. I'm especially honored and super happy to be here today to speak to you all. And look forward to a robust conversation with you. I want to especially also thank Dan Anford and for the invitation to come and speak to you today. And I also want to extend my appreciation to the rest of the passive investing team for putting together such an incredible platform that allows us to engage in these types of conversations. Before I dive right in, I just want to just share a little bit of a disclaimer. Obviously, what we talk about here is going to be mostly educational. Please feel free to confirm any statements or discussions that we have with your financial advisor or other licensed professional. The only thing I'm licensed to do is replace people's hips and knees. So I really have no license to offer any financial advice to you. Now that we've gotten that out of the way, I'm happy today to talk to you about the ABCs of passive investing in multifamily real estate. Sounds like a mouthful, but another way to ask that question really, or to just break it down for you, is to say, would you like to be a part owner of a building like this? You know, this is a 113 unit building in Columbia, South Carolina, which I realize Dr. Dan Anford and some of the passive investment team are based. Would you like to be part of this building? If this seems like a really attractive proposition to you, then please stay with me for the next 30, 40 minutes or so. And my hope is to show you that it is possible for you, even you as the busy doctor and busy professional, to be a part owner in a project or building like this. Like many of you, as a physician, we don't get much of a financial education. You know, we are mostly taught to just focus on taking care of our patients, which is super important. And we certainly do a great job of doing that. And we are trained to be great workers and worker bees, and to just mainly focus on trying to give our patients the best outcomes. And we, in becoming physicians, we've been kind of taught to mostly outsource all of our wealth creation or financial independent strategies to other folks. So you are supposed to become a doctor, and then you're supposed to max out your 401k, you know, invest in stocks, bonds, maybe some funds. You know, I'm sure almost all of you have heard about the backdoor Roth IRA. And then obviously, if you have kids, you want to put some money away for the college savings plan. And the financial advisors particularly love the insurance products, the disability insurance, annuities, whole life insurance, because they get commissions, and it gets them to financial independence a lot quicker than you are going to get. I am not saying this to say that all of these things are bad. I'm saying these things are good. It's great to max out your 401k. It's great to invest in equities, and it's great to have a backdoor Roth IRA and protect yourself with disability insurance. But you've got to think outside of the box and start to take charge of your own financial future at some point too, and explore other alternative assets that can get you to financial independence. So my experience was initially when I started practice in 2013, was to listen to the classic way of doing things. I definitely maxed out my 401k as told. Created a backdoor Roth IRA as instructed. I also had a brokerage account that was being managed by a financial advisor, and had my disability insurance set up. And I thought I wanted to, take a little bit of charge of my financial future, and started to explore single family investment properties, because that was what was most commonplace. And in my studying and reading, that was kind of what I came across as a vehicle for wealth creation. So I bought some single family investment properties, and quickly realized that I was a poor landlord, and that I also did not enjoy the process of dealing with tenants and toilets and termites, like they say. It just was not a fun process for me. And in addition to the process not being fun, the cash flow coming from this single family properties weren't as impressive as I expected. Matter of fact, some of the surprise expenses were easily kind of wiped out my cash flow from the investments. And even when I got a property manager to manage the property, one, it reduced my cash flow even further. And second, I still was required to make some active decisions as to, what I wanted to fix and things of that nature. And I was still pretty actively involved in the decision making on the investment properties. I also was lucky to segue into angel investments pretty early on. I invested in multiple startups. And for those of you that understand what angel investments are, you realize that they are high risk, high reward plays. It's not uncommon to expect that out of 10 investments, that maybe one or two of them are going to be successful. But your hope and prayer is that those one or two that are successful are so successful that they make up for your investment in all 10 startups. So obviously that was a high risk, high reward play. And it's certainly a long-term strategy, certainly not a way to achieving stable wealth growth. And so I started to explore. Around the time that I was exploring was when, COVID hit. And that was like in early 2020. And all of a sudden, my identity as a busy orthopedic surgeon was pretty challenged, because I found myself sitting at home for 2 to 3 months doing nothing but seeing a few telemedicine patients. And I got a chance, like many of you did, to really think a lot about how I wanted to structure my financial future moving forward. I thought a lot about the fact that I got to spend a lot of time with my family, and it was so much fun to spend time with family. And I also really started to really enjoy the time that I was spending doing some of my global orthopedics work. During that pandemic shutdown, I actually got a chance to do some virtual education of different surgeons in different parts of Africa. And before that, I was doing a lot of work going back to Africa, teaching, helping to expand access to musculoskeletal care quality musculoskeletal care in lower to middle income countries, starting with Nigeria, where I was born and raised. So that work was very interesting to me. And there was no way I was going to have time freedom to fully participate or significantly participate in that work as much as I wanted, or even spend time with family as much as I wanted, if I continued to, on the path where I was doing incredibly wonderful surgeries, but that required me to be there. It required me to exchange my hours for dollars. I was doing between 400 and 500 surgeries a year, and that was a pretty busy practice. So I needed to buy my time freedom back so that I could do some of the things that I loved. And for you, those things that you love may not necessarily be to participate in global orthopedics or do international work. It could be just to spend time with your family. It could be to explore and travel more. It could be to explore some new pet project that you've always wanted to participate in. It could be to participate in your favorite charity and volunteer a lot more. Whatever financial freedom is to you, it is very clear that we need to buy our time freedom back, and we need to ultimately achieve financial freedom to be able to fully participate in them. And for me, financial freedom is defined as the ability to do whatever you want to do, when you want to do it, with the people you want to do it with, wherever you want to do it. So, particularly for me, the geographic freedom and the time freedom was probably the most important. And I realized that having the financial capability to do that was going to be important for me. So the exploration continued. Around the same time, I also discovered that a lot of us surgeons, doctors in general, are actually not wealthy. We are rich because we make a relatively high income. But when you actually look at the Medscape Physician Debt and Net Worth report from 2020, 50% of doctors have a net worth of less than 1 million. And this is including their primary residence. So if you actually was to exclude the primary residence, which is how the SEC defines accredited investors, I mean, that number actually would be much higher of folks with a net worth of less than $1 million. And this makes sense because we are really just highly paid skilled workers, and we can pass on our highly paid skilled work to our progenies or our future generations. We are going to have to pass on assets to them. And as far as we are trading our hours for dollars, there's a limitation to the income that we can make. Because we mostly highly, either W-2 income earners or even self-employed folks, we have a very high tax burden because we have earned income, and we usually are in the top or close to the top tax bracket, so exposing us to quite a bit of tax burden. Also, to complicate things, a lot of us have student loans, and those usually increase the financial burden on doctors. And finally, we like to keep up with the Joneses. We've delayed gratification for years, in some cases 12 to 14 years of training and education. And we just want to now buy that nice house and buy the nicest cars and get that country club membership and travel to the nice vacation spots and just keep up with everybody else, because we are doctors. So it takes a little bit of reorientation to be able to realize that things need to change. And around this time also, with all of the reading that I was doing during the pandemic, I saw a few quotes that just resonated with me. And actually have not been able to confirm the veracity of some of them. I love them anyways, and since they inspire me, I subscribe to them. So the first one, which said that over the last 2 centuries, 90% of the world's millionaire got their wealth from real estate. I think that's mostly ascribed to Andrew Carnegie, but I've not really been able to confirm exactly where he said it. But it makes sense because a lot of people get their net worth from their primary residence, and it makes sense that a significant portion of the world's millionaire would probably get their wealth from real estate. And the average US millionaire has 7 sources of income. I realized that I only had maybe about 2 sources of income at that point, maybe 3 max. And I needed to add a few more to it. And certainly I didn't have any more time to give. So I needed to find ways to have passive income. And another quote that really resonated with me around that time was that you cannot save your way to wealth. Because I mean, coming from the background that I came from, I just thought that it was okay to just save as much money in the bank and walk into the bank and have those, private bankers treat you like a king, a queen. And that was fun for a lot of us. But there's a reason why those private banking bank relationship managers love you. That's because they take all the funds that you're saving in the bank, they invest it in different things, including real estate, make significant amounts of returns on it, and give you less than 1% on return in your savings account or money market account. And so when you think about it that way, you realize that you have to put your money to work. You cannot save your way to wealth. And also in this very high inflationary conditions that we are in, with inflation going up to about 6%, maybe more, you live your money in the bank that is not your emergency funds or funds to protect any surprises in the future. Is literally losing value. I mean, if the inflation maintains for the next few years, you'll be losing a significant portion of your purchasing power of that amount that you have in the bank. So I realized quickly we have to put money to work. So the question is how? Well, I was already sold on real estate based on some of those things that I was reading about real estate. So the common real estate investment strategies that were readily available to me that I thought were within my reach were, first, single family rentals. I had already started on that. I didn't like it. I didn't like dealing with tenants and all the things associated with that. I read about flips, and it just seemed like pretty active. Like you were going to have to be very actively involved with the general contractors and in the buying and selling process of it. And then I read about the BRRRR strategy, which is very intriguing and very interesting, but also, once again, required quite a bit of active participation. You buy, you rehab, you rent, you refinance, you repeat. And so I was like, okay. And then you do it again and multiple times. And hopefully, eventually, you get to a place where you have significant enough cash flow that you can achieve financial independence. There's short-term rentals, like Airbnbs and arbitrage and things of that nature. I read about those. They just seemed like they were still going to be relatively active for me. And small multifamily, things like quads, triplexes, and duplexes. I heard about those too, and they seem like definitely better than single family, because at least when you have vacancies in one of those units, you still most likely have occupancy in the other ones. So there was a little bit of protection for you in that regard. You weren't just exposed to fully having to pay your mortgage if you had a vacancy in your unit, like it would be for a single family. For me, multifamily just did not really occur to me initially. I just didn't think. I mean, obviously, I'd lived in apartments before, and I see every time going to work or coming back from work, I see multiple apartment buildings. I just didn't think it was possible for a doctor or a professional like me to participate. It seemed almost a little too difficult. And just for the purpose of this discussion, and typically for loan purposes, any multifamily property more than 4 units, so 5 units and up, is considered an apartment building and treated as commercial residential. It was around this time that I met my partner, one of my partners at XSITE Capital, Leslie Allison. It was actually one of my CRNAs at my job in Baltimore, where I was replacing people's hips and knees. It was putting my patients to sleep. And at some point during surgery, or maybe after surgery, we would have all these discussions about investing and real estate. And he had introduced me to multifamily and told me to just kind of read up a little bit about it. And then I dived right into like multiple books, including Wheelbarrow Profits, The Hands-Off Investor, the best ever apartment syndication book by Joe Fiales, and then was constantly listening to podcasts on my way to and fro from work. And some of the podcasts are those listed there. I really, truly enjoyed engaging with the best ever podcast, the Lifetime Cash Flow podcast, and the Multifamily Investor Nation podcast. And by just listening to this podcast, it became very apparent to me that passive or active participation in multifamily was also available to someone like me, and that it could potentially be a pathway to that financial independence and the time freedom that I was seeking. And some of the things that I quickly learned from diving right into all of these things is that in all of these educational materials, including the podcasts and the books, that one, I could be hands-off if I wanted to. I could literally just put my money to work, invest in these deals with vetted vetted sponsors of multifamily properties, and just let them, and leverage their expertise, their time, their energy, their, and their resources to make sure that I was, growing my wealth and creating significant and accelerating my wealth growth. And there was also an opportunity for cash flow. I thought that was incredible, that not only would I be able to take advantage of the organic appreciation or the forced appreciation that these experts were going to be able to do, but I will get access to either monthly or quarterly cash flow. That was very important to me. Also, I quickly realized that the housing market is relatively a good edge against inflation, and that typically the values go up and matches inflation, at least compared to many of the other asset classes that we were exploring. And once again, I quickly realized also that banks, insurance companies, Wall Street, and many private, family offices, the smart money were buying a lot of multifamily. And so when I saw that was the case, particularly in this high inflation environment, I definitely knew that I had to participate. This below average risk compared to stocks, and certainly above average returns. Most of the deals that I was looking at, I was hearing about, had average annual returns of over 15%. I couldn't believe it. It was amazing. And extraordinary tax benefits. I couldn't believe, my mind was completely blown when I heard about cost segregation, which is just where the sponsors actually invite a cost segregation expert, which is a CPA and some structural engineers, to depreciate everything besides land and building. And they are able to pass on some of that depreciation to us passive investors. It was incredible to me that now, because of this depreciations that I am making money in the form of cash flow coming from these buildings, but then I'm also enjoying depreciation from real estate that I could use to offset any other passive income that I have. And also I can use to offset all of the cash flow that I'm getting from that particular property. And it gets even better. If your spouse or yourself are able to achieve real estate professional status, now the depreciation can also offset your earned income from your W-2 or 1099 income. I thought that was just amazing. And there are so many other benefits. Multifamily real estate is scalable. As a passive investor, you literally could just, you could invest in 100 deals. You can invest in 5 deals, and you didn't have to put that much more time into each one of these deals. You just leverage other people's expertise, you leverage their time, you leverage their resources. Once again, there's lower volatility with real estate. Yes, there may be some correction, but for the most part, with this large multifamily apartments, you can weather the storm. And once again, you're leveraging other people's expertise, and this is a tangible asset. I can actually physically go, touch, walk through, see this asset class. That was very attractive to me. And also, some of the additional benefits, these experts that are doing these deals can actually force appreciation. So these deals are businesses. They're buying them, they're adding value to them, and increasing their revenues on these deals, decreasing the expenses, thereby increasing the net operating income, which eventually leads to a significant increase in the value of the property. The investment property paid for itself. That was impressive to me. And the fact that there was a trend of baby boomers and millennials renting in record numbers was very attractive. It showed me that this was something that we could invest in for the long term. And there's a shortage of safe, affordable housing nationwide. I've even seen a number of up to 4 million shortage of units, of apartment units in the US right now. And development is not catching up with filling up that gap. So when there's that much of a demand supply dynamic, where there's a shortage of apartments, then most likely that shows that this is a good asset class to invest in. And with the amount of cash that's sitting on the sidelines, without capitalized the US is right now, the prediction is that this is always going to continue to be a very competitive asset class in the next 3 to 7 years at the least. And also, multifamilies outperformed stocks for the last 30 years. This was very exciting for me. So when we found out about this, Leslie and I and my third partner, Tenny, also quickly realized, going to a lot of conferences, that there was a significant gap with me in those people that were participating in multifamily. We couldn't believe the great, advantages of multifamily real estate, but we didn't see that many real estate healthcare professionals participating in it. We saw a lot of accountants. We saw definitely a lot of MBAs and business folks, a lot of finance folks. We saw lawyers, maybe even some tech folks. But for some reason, healthcare professionals were not actively participating in it. We were certainly inspired by folks like Vikram Raya and Ravi Gupta from Viking Capital, who ended up becoming our mentors also, because there were some of the few medical professionals who were participating in this asset class. So, and we also noticed that in many of these conferences, we didn't see folks that looked like us. We didn't see minority professionals. And so we really then decided that there's an opportunity here to go out onto the mountaintop and preach the gospel of multifamily to as many people as would care to listen to us, particularly those people in the aforementioned slide. So that's exactly what we did. We started the company XSITE Capital, got mentorship, and focused on the task at hand, which was to educate as many people as would listen to us and collaborate with as many of them that are willing to go on the journey with us to acquire multifamily real estate assets. And how do we do it? We do it by combining resources together with our community of investors to purchase the apartment communities, which otherwise would have been impossible to purchase by ourselves. And our investors also may not have been able to purchase them by themselves. And the way it works is we acquire the property as the general partners. We implement a value add strategy. And when that business plan is completed and throughout the business plan, we are enjoying the returns with our community of investors. And we then decide to sell or hold depending on what the market conditions are. And the general partners, like some of those companies that are listed on the right, are the ones who find the property. They do quite a bit of work to, develop relationship with brokers and sellers to find the properties that are going to be ideal for the community of investors. They underwrite the properties. And when I say underwrite the properties, they literally put in some assumptions and try to see if this property is a good business to buy. And just to kind of give you an idea of what this takes, they will have to review hundreds of deals just to underwrite tens of them, and before they actually can present one deal to their community of investors. And then they secure the financing, they raise the capital, and ultimately they manage the business plan until the business plan is completed. The limited partners, which could be you, and in some cases is me when I invest in other people's deals, they invest in the deal, they obtain their share of the profits. They are not involved in the day-to-day management, so they're typically end-self investors. In most of these multifamily syndications or private placement investments, the typical minimum is about $50,000. In some, it's $100,000. In some smaller ones, it could be $25,000. And the benefits, once again, is that you're getting cash flow throughout the course of the deal. You are sharing in the profits and the exit of the deal. And you can also invest using your retirement plan. A lot of people think you can only invest your cash. You can actually use your self-directed IRAs, like say solo 401ks or SDIRA, things of that investment accounts of that nature. You could actually invest in these deals through that. And that is something that I can answer to you if you have some other questions about that later. Once again, the limited partners are not responsible for day-to-day management of the asset. And to participate, typically, you have to be an accredited investor. There are some exceptions to this, but for the most part, an accredited investor is a person who's making at least $200,000 a year, or $300,000 as a couple, or as a net worth, excluding their primary residence of $1 million. So let's just look at this example. Let's assume this building is a 100-unit apartment building. it's just an example. This is not an 100-unit apartment building. This just for example's sake. Let's say it is. And that we're trying to buy it for $30,000. The down payment for this could be, let's say, 7.5 million. I mean, I said 30,000, $30 million. I apologize. And let's say the down payment is $7.5 million. And that the rehab budget, that's the capital expenditure on this to add value to it, is going to be about $2.5 million. So that means now that the general partner has to raise about $10 million. And so they usually would go out to the community of investors and raise that money. And just as an example, this is just an example of what a renovation of one of our properties that we acquired last year was. We took that clubhouse and renovated it to something more modern, something with a lot of light, something that is attractive to tenants, so that the tenants will be willing to actually pay for what the value that you had into them. There are other ways to add value. You could renovate the apartments, improve the aesthetics of the kitchen, of the living room, of the bathrooms. You could add a dog park. You could update the swimming pool area. You could put in a playground. You could put in a workout area. You could add smart upgrades, including locks and thermostats. I mean, the list is very long and the list is endless, but the whole idea is to add value to the tenants so that they are willing to pay for that value that you've added to them, which in turn improves the net operating income on the property and generates incredible wealth growth for the passive and active investors. And just a quick review of what we look for in properties. And I mean, in the target market, we love target markets with stable industry, with a variety of Fortune 500 businesses, a lot of shopping malls, a lot of healthcare hubs. We love communities with universities, with high renters versus homeowners. We love cities with a huge population that is continuing to grow. We love to see increasing population growth, increasing median household income growth, increasing job growth, and increasing rent growth. We love cities with airports. We love state capitals. We love cities with sporting teams and sporting events, because those are markers of a vibrant, growing community. An example is Charlotte, North Carolina, which is one of our target markets, which is projected to continue to grow significantly over the next several years. It's got a significant amount of population, over 1 million residents. It's the largest metro area between Atlanta and Washington, D.C. And look at that projected rent growth that continues into the years ahead. So this is the kind of market that you want to look for, that you want to invest in, because you're certainly going to be able to. A good market will save a bad deal. So, that is this is why we put a lot of work and use data to determine where our target markets can be. And I just cannot emphasize the importance of forced appreciation enough. This is just an example of one of the properties we bought, where we were able to add significant value to the property and were able to generate an additional $150 in rents in all of the 132 units in the property. And just by doing that in a 5% cap rate market, we were able to increase the value of that property by over $5 million. That is incredible. And you tell me how many other asset classes can increase value that fast, and in a very deliberate way like this. Not that many, particularly when you mix in the tax benefits of this asset class. So I hope I've convinced you that passive investment is the way to go, or particularly as a busy physician. A lot of us love what we do. I, for example, don't anticipate ever stopping to do total hips and total knees. I love what I do. I enjoy it incredibly. I just like to do it on my own terms, where I'm not dependent on trading my hours for those dollars. And so when you're able to invest in an opportunity that just yields return without you having to put an additional funds or additional work or even additional input, that is when you're starting to achieve significant, that's when you can achieve significant passive income. And when your passive income exceeds your lifestyle expenses, then you're officially financially independent. So I just put an example there of how much you need to invest at a 10% annually to, if your goal was to make $100,000 in passive income per year, then you need to invest about $1 million. Yeah, if the returns was about 10%. And just like I showed you earlier, a lot of the returns with multifamily actually is much higher than that. 15%, 20%, 25% in some cases or more. But the cash flow in some cases is between 6 and 10%, depending on the class of investment that you are interested in. So you may not have $1 million today, but you may have $50. Well, you got the journey of 1,000 miles. Start with the first step. So you could start with the $50,000 invested and start growing that money in this asset class and protecting your tax liabilities with the tax benefits coming from this asset class significantly. So I'd say the best time to invest in multifamily real estate was, 20, 10, 5, maybe a year ago. The next best time is now. And just as I'll spend the next few seconds just kind of telling you a little bit about that same building. I hope you remember this building. From the beginning, I had asked you, if you thought that, that you could be a part owner of this building. Well, I'm happy to tell you that it's a possibility. This is actually a live deal that we're about to close on at XSITE Capital, and that if we still have a few spots left. Obviously, there's no need. You don't have to invest if you don't want to, but if you are convinced that passive investment is for you, you may want to take a look at this one. It's a 113 unit in downtown Columbia, South Carolina, Class A property that we're buying at $17.45 million. And it's a 7-year-old that we are adding some significant value to. And we're anticipating that that you will be able to get at least 7% in cash and cash returns. That's annual returns divided into quarterly payments. And at the end of the business plan, you share in the profits also. And we are projecting that you will be able to get at least 19 to 25% in average annual return, and an equity multiple of 2.3 to 2.7x, which means that if you invested $100,000, you will end up with about $230,000 or $270,000. What a way to start growing your wealth. And this is our team at XSITE Capital. We are happy to answer any questions you may have. Thank you so much for the opportunity to speak to you today. Please feel free to visit at XSITE Capital, and we'll be more than happy to continue this conversation there. If you have any questions, I'm here to answer them. Thank you.
Dr. Julius, thank you so much. That was tremendous.
Thank you so much, Andrew.
Yeah, I actually have one question for you. It didn't come in through the panel right here, but a couple questions that I don't think that you hit. If you did, forgive me. But one of them was in terms of income from real estate. The question is, let me see if I can summarize it well here. Does depending on which asset class you invest in or asset type, I'm guessing is what they mean by this. Is it all treated the same in terms of income if you're investing passively? So if you invest passively in self-storage, multifamily, mobile home parks, whatever it may be, is that income treated the same if you're a passive investor, or is it treated differently based on the asset class or type?
I see. Yeah, my expertise is multifamily. I have not done more significant self-storage or even mobile home parks, but I would imagine that those investments are going to be treated similarly, particularly if it's structured still as a syndication. Because really, what a syndication is just a private placement investment. Right. And it doesn't really matter what asset class that you talking about. I'd be mobile home park, self-storage, or multifamily apartments. It's treated somewhat similarly because it's structured very similarly as a 506B or 506C, offering. So I would imagine that, and for all of those asset classes, you also could still, depreciate some of them, just like you would depreciate an apartment. Now, the extent to which you can depreciate them may vary, and that would be something to discuss with the sponsor when you're considering those investments. But the short answer to that is, for the most part, yes.
Okay, very good. And then a question from Brian here. He wants to know, what is the smallest amount of money that he can invest to get started learning and growing?
That is great. So there's no small amount of money. There's no minimum amount of money that you can invest in starting to grow. The smallest amount of money is $0. As far as you have access to podcasts and you can access some books. Just listening to podcasts alone is going to significantly improve your knowledge about this asset class. So you can certainly listen to some of those podcasts that I listed on the talk, but you could also just type in multifamily real estate into any podcast platform, and probably hundreds of podcasts will pop right up. So, and a lot of the speakers in this conference have their own podcast, and they do, fantastically well. Certainly at XSITE Capital, we have a monthly meetup every first Monday of the month. And we get people from all over the country, and we have a nice, robust conversations about multifamily real estate topics, and certainly also personal development topics. And all of those things are going to help you grow. Now, if you're talking about investing in this private placement investments, then typically the minimum would be $50,000. But even if you don't have that, and you just want to fractionally invest in smaller in crowdfunding platforms. You have platforms like Fundrise, CrowdStreet, Realty, Mobile, or So the possibility are endless, and you could certainly start also with REITs, just like almost like real estate stocks, if you want to think about them that way. There are multiple options to start investing in real estate passively, but obviously, as a multifamily syndicator, I strongly believe in the private placement strategy, because I've seen it work for me, and I've seen it work for our community of investors. And I certainly hope that you're able to join us at some point.
Very good. Well, thank you for that. Yeah, and to your point, this is obviously, we've aggregated a lot of knowledge and expertise here today, but one of the books I think for people that really want to get just a tremendous amount of education in this space as passive investors is the book you recommended, The Hands-Off Investor by Brian Burke. I've read a number of books about passively investing, actively investing, real estate investing, as you might imagine, in my career, but Brian just has done a tremendous job of giving really, really good information. And I would say that as an aspiring passive investor, Brian, the questioner here, as an aspiring passive investor, that's a tremendous book to start with, to really get a sense of how to properly vet sponsors, how to think about the marketplace, what questions to ask.
So,
That would really get you up to speed very quickly. And then, of course, Dr. Julius, some of the crowdfunding platforms that you recommend oftentimes allow for a smaller investment.
absolutely.
Some as little as $5,000, to where you can really get a sense exposure to the market and really see how that process works. And often when I'm chatting with passive investors on the phone, and they're new to it, and we're immersed in the space, and they're new to it, and they're only really accustomed to stock market investing. My suggestion is always, look, make the smallest investment that you're comfortable with, and just to get exposure, and you'll learn. I'm very much a learn as you go, or a kinesthetic learner. So you can only do so much analysis, and definitely do your analysis, do your due diligence. But at some point, you've got to jump in where you're comfortable and with the amount you're comfortable, and you'll continue to learn as you go.
Absolutely.
Yeah.
Great insight, Andrew.
Yeah. Well, Dr. Julius, this was amazing. Congratulations on all your success, both professionally as a physician, but then also for the company that you've built, the assets that you're acquiring. And I think you've already mentioned it, kind of shared your contact info and where people can find out more about you. Will you be around if people want to ask you questions in the Hoover app today?
Absolutely. I'm going to be in and out, but feel free to reach out to me. My email address is also juliusoni@xsitecapital.com. So pretty easy. Mm-hmm. So feel free to reach out anytime, but I'll be in and out of the Hoover app, and I look forward to interacting with everyone today. Thank you.
Okay. Very good. Well, thank you so much. Great to have you. Feel free to jump off whenever you're ready, and we'll have a short break here between the next session. So
thank you so much, Andrew. Really appreciate the opportunity.
Oh my gosh. Thank you. Our pleasure.